ASMR Dano video. And as the title says, I'm going to bore the heck out of you so that way you can fall asleep as easily as you can. Now, for those of you who are having a hard time to sleep, you may have tried a cranial nerve exam video, maybe a trigger assortment, or whatever your favorite trigger is, or a full 3-hour video of rain sounds against the window. I'm here to say that the best way to fall asleep is to bore your brain so badly that you have no other choice than to just close your eyes and sleep. Now, today we're going to be doing that, or attempting to do it, by reading a book, which is a finance book. Now, I'm not going to say or show the title because I don't hate the book. I'm just saying there is a lot of technical terms in here. There's some mathematical equations and formulas, and we're going to be starting in the very, very middle of the book because I don't want you to have any clue as to what it's talking about. Further in the book, it expects you to have some sort of knowledge from the beginning of the book to understand. So if you don't have that knowledge and you can't understand, then hopefully your brain will shut off and fall asleep and just ignore what it's saying and just listen to the sounds, and hopefully just ease your mind and help you to fall asleep. So that's the goal today. I'm going to read as much as I can before I fall asleep. And if this doesn't work, let me know. And maybe we'll try another way to bore you. But today we're going to be going to read a couple of chapters, or maybe just one chapter, we'll see. There are also some mathematical formulas and symbols that I may not know. So I'm just going to guess. I'm going to say circle symbol or triangle symbol or whatever it is, okay? So first we're going to have to try and find a spot in this book. Let me see. Ooh, yes. Correlations of returns. Perfect way to fall asleep. This is chapter 9, okay? And it's like, it has sections, so it's like chapter 9, section 3.2. So it's not even the beginning of chapter 9. We're going to start further past that and randomly in the middle. Okay, so I want you all to breathe. Oh, actually, let's have a little session of breathing just to help us relax and calm ourselves down, so we are able to fully not digest this book. So let's go. One more time. Hold it. Blow. Release all the energy. Release all the anxiety and the stress. Okay. Here we go. Correlations of returns. Next, we look at the correlation coefficients among the returns of the 5 asset classes. What are the 5 classes? We don't know. Correlation coefficients measure the extent to which one random variable co-moves with another random variable. The theoretical maximum for the value of correlation coefficients is +1, i.e., the 2 random variables co-move perfectly, positively with each other, while the theoretical minimum is -1, i.e., the 2 random variables co-move perfectly negatively with each other. A coefficient of 0 implies that the 2 variables are not related. The correlation coefficients are displayed in table 9.2, which you will not see. There are a few things to note from the table. First, the returns on cash equivalents and fixed income securities were almost unrelated to the returns on equity and commodities. The correlation coefficients are very close to zero. Secondly, commodities returns in either currency are positively correlated with equities returns. However, the correlations are not very strong. The coefficient between commodities returns and equities return is only 0.32. In other words, commodities returns, I said the wrong thing, commodities and equity tended to move in the same direction, but not very frequently. Finally, real estate and equity had a strong correlation, 0.72. This is not that surprising considering that the two asset classes depend on most of the same economic factors. Alright, not bad. 9.4. Asset allocation and diversification. Now that we know the risk-return profiles of the 5 asset classes, one very important investment decision that you have to make is how to allocate your investment among these asset classes. Essentially, we are talking about the concept of diversification, which will be formally discussed in the next chapter. Maybe we will see, maybe we will. You want to spread your wealth among different asset classes to take advantage of the imperfect correlations among them. In some years, some asset classes may do well, while the others may not. On average, you balance the good with the bad, and hopefully you come out ahead, or not having a heavy loss every year. For example, consider the year 2002. That was a very, very long time ago. If you had put all of your investment in Canadian equity, the rate of return on your investment, according to table 9.1, would have been 12.44%. Now, it has a negative sign, but I don't. Oh, it is negative 12.44%. Damn, you will lose your money if you invested in Canadian equity. That's really sad. If, however, you had spread your investment evenly among all the 5 asset classes, i.e. 20% in each, your return would have been 0.2 times 2.77 plus 0.2 times 5.08 plus 0.2 times negative 12.44 plus 0.2 times 22.85 plus 0.2 times negative 1.82, which equals 3.29% per year. Which, while not great, would still have been acceptable in such a year. Your allocation decision will depend primarily on 2 factors. The first factor is your risk preference. If you are risk averse, like most people are, you'll perform a trade-off between returns and risks and choose the asset mix, i.e. how much in safe assets and how much in risky assets, with the overall risk-return profile they are most comfortable with. The second factor is the nature of your economic balance sheet. In particular, you should take into consideration the 2 biggest assets that you have, which are your gross human capital, which they discussed earlier, and your house, if you own one. Let's consider first your gross human capital, as discussed in Chapter 3. Your gross human capital has its own risk-return profile because different occupations have different inherent risks. For example, an investment banker or a stockbroker has income that is highly dependent on stock market conditions. When the market is doing well, you will likely earn a substantial bonus. On the other hand, when there is a recession, like the one in late 2008, you will not make as much money or might even get laid off. Consequently, his gross human capital has a risk-return profile that is similar to equity. and so it may not be wise for him to put a lot of his savings into equity. Rather, he should diversify into other asset classes such as fixed income. In contrast, consider a tenured university professor. Her job is stable and her salary does not depend, at least directly, on stock market conditions and stock market movements. As a result, her gross human capital has a risk-return profile that is similar to fixed income assets. In this case, she can afford to take more investment risk. And just so we don't die from thirst, I'm just going to take a water break. Where was I? Okay. We want to emphasize that the determination of the risk-return profile of your human capital can be a difficult task, especially if your job falls somewhere between the two extremes, i.e., fixed income versus equity. The profile will only become evident over time. To make this point clear, consider the following example. Practice question. Consider a 50-year-old professional whose job is relatively safe, such as a quasi-government job. Her net human capital is $600,000. She has a risk-return profile similar to a portfolio of $400,000 in bonds and $200,000 in stocks. In addition, she's managed to accumulate $500,000 in financial capital. If she wants the risk-return profile of her whole economic net worth to be 50% risky and 50% safe, how should she allocate her financial capital? Her economic net worth is now $600,000 plus $500,000, which equals $1.1 million. To split this evenly between risky and safe assets, she needs to have $550,000 in each, because her net human capital already represents $400,000 worth of safe assets. The rest should be invested in risky assets. In other words, her financial capital should consist of $150,000 or 30% in safe assets and $350,000 or 70% in risky assets. Note that anyone who only looks at her financial capital may mistakenly conclude that she's taking too much risk. However, she has achieved her overall desired asset mix. Her relatively safe human capital allows her to take more investment risk. Next, consider the role of a house in making investment decisions. Most Canadian households already have an investment in real estate in the form of their houses. According to Statistics Canada, the home ownership rate, i.e. the proportion of households who own their home either outright or with a mortgage, was about 68% in 2006. The next census will come out in 2011, and I'm guessing this book was made a pretty long time ago. For these people, their overall portfolios are already significantly overweight in real estate. Consequently, it may be a good idea for them to direct their future savings away from this asset class. For people who are renting, however, they will not have this constraint, and so they can afford to have more exposure to real estate. As we mentioned earlier, an investment in real estate, such as owning a REIT, R-E-I-T, can help these people to hedge their sheltering needs. In summary, when you make an allocation decision, you want to diversify your whole economic balance sheet, and not just your investment portfolio. Obviously, it can be a long, gradual process to achieve diversification. This is especially true when you're young and most of your assets are in the form of your human capital and house. As time passes, you gradually convert your human capital into financial capital. It is during this period that you should move your allocation toward the desired combination. Mutual funds and exchange-traded funds. The most efficient way to invest in a large portfolio of securities is to buy mutual funds and/or exchange-traded funds. Although the underlying idea is the same for the two kinds of funds, there are important differences between them that investors should be aware of. 9.5.1 Mutual funds. A mutual fund is an investment pool that accepts money from many investors and invests that money in a portfolio of securities. Depending on the stated objectives of the fund, the securities in the portfolio can be anything from the 5 asset classes mentioned earlier. The funds can either be actively or passively managed. In an actively managed fund, the fund manager attempts to generate good returns by choosing which securities to hold, given the fund's mandate. In contrast, a passively managed fund simply attempts to mimic the movements of some bond or equity index, and thus it is sometimes referred to as an index fund. There's no significant managerial input on the composition of the underlying portfolio. In addition, the portfolio is not frequently revised. Types of mutual fund. As of 2011, which is 14 years ago, oh my goodness, there are now, as of 2011, approximately 200 mutual funds companies in Canada, although they offer close to 10,000 mutual funds to investors. These funds can be categorized into various types, the most common of which are as follows. Money market funds. The goal of these funds is to generate stable income with good liquidity. They invest in securities that belong to the cash equivalents asset class, such as T-bills and high-quality commercial papers, unsecured, short-term instruments issued by corporations. They are relatively low risk. Bond funds. These funds generally invest in government bonds and investment-grade corporate bonds. As a result, they keep the default risk low, and so the main risk is interest rate risk. There are, however, some bond funds that invest in non-investment grade bonds, i.e. junk bonds. These funds aim to generate higher yields in exchange for taking on default risk. Consequently, they are more speculative in nature. The advantages of bond funds are that they are diversified and more liquid than individual bonds. Dividend funds. These funds aim to generate dividends with a small possibility for capital gains. They invest in preferred stocks and common stocks that have good records of consistent dividend payments. Growth funds. These funds intend to maximize capital appreciation, investing primarily in common stocks of high growth firms. They are riskier than dividend funds. Balance funds and asset allocation funds. These type of funds are very popular in Canada. They aim for a mixture of income, growth, and safety. They hold both stocks and bonds, and usually have guidelines for the weight in each asset class. International funds. These funds invest in stocks and stock indices of foreign countries. They may concentrate on a specific region of the world, such as Europe or Asia. They provide diversification benefits to investors who have a high percentage of their wealth invested in Canadian stocks. We're going to have another water break. I hope most of you are already asleep. I feel like I could go to sleep already. math. Okay. Mutual funds expenses. A fund's expenses comes in two categories: sales commissions and management fees. With respect to sales commissions, mutual funds can be classified as load funds or no load funds. A load fund is a mutual fund where investors pay a commission when they buy front-end load or redeem back-end load fund units. The commissions are intended to compensate the fund's sales force, e.g., brokers, advisors, and financial planners, for the explanations and advice that they give to investors. Generally, the commissions are a few percentages, e.g., 2% to 5%, of the value of the investment, though higher rates exist. Front-end loads also depend on the size of the investment. The higher the amount of the investment, the lower the rates are. The rates of back-end loads depend on how long the funds are held before you redeem them. The longer the holding period, the lower the rates are. Both front-end and back-end loads have the effect of discouraging short-term investment in the funds. The front-end loads are deducted from the value of your investment when you purchase the funds. For example, suppose you decide to invest $10,000 in a fund that charges a 3% front-end load. You make a payment of $10,000 and $300 will be deducted from it, which means that the amount available for investment is $9,700. The back-end loads, on the other hand, are subtracted from the proceeds when you redeem your investment. For example, suppose you want to withdraw $5,000 from a fund that charges a 4% back-end load. You will end up with $5,000 minus $200, which equals $4.8K, or $4,800. A no-load fund, on the other hand, does not charge commissions and is available from mutual fund companies and banks that sell their products directly to the public. You can also buy a no-load fund through a discount broker. The secondary category of mutual funds expenses is management fees. Management fees, or management expenses, are intended to compensate the fund companies for their operating costs, e.g., bookkeeping costs, investment management costs, operating costs, marketing costs, and other administrative expenses. They are charged as a percentage of the fund's total assets and therefore are typically referred to as fund management expense ratios, MERs. MERs typically range from 0.25 to 3% per year and are deducted directly from the fund's values before the fund's performance is calculated. MERs usually depend on the types of assets held by the funds. For example, funds that invest in foreign countries usually have higher MERs than funds that invest domestically. One important component of MERs is service fees, or trailers. Service fees are ongoing compensation that mutual funds companies pay to financial planners and advisors for ongoing services that they provide to investors. Trailer fees typically range from 0.5% to 1% per year. Obviously, trailer fees increase the fund's MERs, but this does not necessarily mean that funds with no trailer fees will always have low MERs. People who need investment advice will usually end up with funds whose MERs contain trailer fees. The following example illustrates the effect of MERs on funds' performance. Let's get into some math. Practice question. You are now 30 years old. I'm excited because that means I went back 1 year. You want to invest $10,000 per year at the end of each year in a mutual fund. The fund invests in a portfolio of securities whose expected return is 8% per year. The fund charges a MER of 0.5%. You will retire at 65. How much money will you have at the start of your retirement? And what if the fund's MER were 1.5%? MER is 0.5%. The expected return on the investment after MER is then 7.5% per year. The amount of money that you will have after 35 years of investment is 10,000 times the fair value of assets. Wait, how do I even read that? I'm just going to read how I see it. FVA times 0.075 and 35 equals 10,000 times 1.075 to the 35th power minus 1 divided by 0.075, which equals 1,542,516. On the other hand, if the fund's MER were 1.5%, the expected return after MER is then 6.5% per year. In this case, you have 10,000 times FVA of 0.065 and 35, which equals 10,000 times 1.065 to the 35th power minus 1, all divided by 0.065, which equals 1,240,347, which is lower by more than $300,000. So beware of the fund's expenses. A difference of only 1% per year can translate into a substantial amount of money over a long period. Note that trading costs, i.e. brokerage fees, that the funds have to pay when they trade are typically not included in MERs. This adds another layer of costs to the funds. Actively managed funds will have higher MERs and trading costs than index, i.e. passively managed funds. This is because actively managed funds require regular investment input from the fund's management. They also trade more frequently and so incur more brokerage fees. Benefits of mutual funds. Mutual funds have three major benefits. First, because they accumulate a lot of money, they have economies of scale, which enable them to buy and sell securities in large lots and save investors transaction costs. They also allow small investors to achieve diversification rather than having to buy many individual securities to form a diversified portfolio by themselves. Small investors can buy units of a mutual fund and get to own part of the underlying portfolio of many stocks. Secondly, they simplify your decision-making process. Instead of having to evaluate individual securities, you now only need to decide based on the risk-return profiles of the funds in which you are interested. As a byproduct, the record-keeping process is also less demanding, because you regularly receive a statement listing the values of the funds that you own. Thirdly, mutual funds are a liquid investment. Investors can convert their holdings into cash quickly. Disadvantages of mutual funds. There are a few disadvantages of mutual funds. First, because of the commissions and MERs, they can be costly. The second disadvantage of mutual funds is the below-par performance of most actively managed funds. Studies have shown that actively managed funds, on average, underperform market indices. This is due in large part to their high management expenses. For example, if a fund charges management fees of 3% per year, then it has to beat the market every year by that much just to stay even with the market. The third disadvantage is the tax impact of distributions from mutual funds. Mutual funds are required to distribute the income that they receive from the securities that they hold to the unit holders every year. At the end of each year, fund companies will send investors a report detailing the types and amounts of income. The income includes interest, dividends, and capital gains from the fund's trading. You will then have to pay tax on this income. Note that you have to pay taxes on the capital gains that the fund generates even if you do not sell your fund units. Funds that buy and sell securities frequently have substantial capital gains distributions. 9.5.2 Exchange Traded Funds, ETFs. An exchange traded fund is an investment pool that is similar in concept to a mutual fund. The major difference is that units of an ETF are traded on stock exchanges like stocks. Investors who want to invest in an ETF will buy its units in the market at the prevailing market price. This is different from the case of mutual funds, where investors buy them from the funds or their salespeople, and the price is equal to the net asset value per unit at the end of that day. Investors who no longer wish to hold an ETF will sell its units in the market during trading hours. Again, this is different from the case of mutual funds, where investors redeem their units from the fund companies at the redemption price equal to the NAV per unit at the end of that day. The fact that you can trade an ETF at any time during trading hours at the prevailing market price gives you greater control over the price at which you want to trade. Traditionally, ETFs are passively managed. Their investment objectives are simply to track the performance of bond or equity indices. As a result, ETFs have low portfolio turnovers, and their trading costs and MERs are generally very low, e.g. 0.15% to 0.5%. Keep in mind, however, that because ETFs are traded in the market, you will incur brokerage fees every time you buy or sell them. To avoid brokerage fees negating the benefits of low MERs, you should use a discount broker who may charge as little as $10 per trade. You should also avoid buying ETFs in small increments. 9.6 Summary. Almost the end of this chapter. In this chapter, we introduce the topic of investment. We look at the 5 asset classes and their risk-return profiles. Relatively safe assets such as cash equivalents and fixed income securities have lower returns but also lower risks than risky assets such as equity, commodities, and real estate. In an investment decision, you allocate your savings across these asset classes such that you achieve the desired risk-return profile for your overall wealth. This means that you take the risk-return profile of your net human capital into consideration when you make an investment decision. Diversification is an important concept, as shown in tables 9.1 and 9.2. Different asset classes do not move in tandem. In some years, one asset class does better than others. Therefore, you can reduce your investment risk by spreading your investment over different asset classes. You should also diversify your investment within each class. To this end, mutual funds are a great tool to gain exposure to large portfolios of securities. People no longer need a lot of money to have investment portfolios that are well diversified both across and within asset classes. The benefits of diversification will be explored in more detail in the next chapter. And finally, 9.7 Questions and assignments. Question number 1. If you put in $20,000 into a real estate investment trust in 1999, whose returns mimic the TSX Capped REIT or REIT index in table 9.1, what did your money grow to at the end of 2010? Question 2. Suppose that you decide to split your investment evenly among the 5 asset classes in table 9.1. Calculate the weighted average returns that you would get each year between 2000 and 2010. Also calculate the standard deviation of those weighted average returns. Question 3. Consider a 35-year-old investment banker. Her net human capital is $1 million. She has a risk-return profile similar to a portfolio of $200,000 in bonds and $800,000 in stocks. In addition, she has managed to accumulate $100,000 in financial capital. If she wants the risk-return profile of her whole economic net worth to be 50% risky and 50% safe, how much should she allocate her financial capital? How should she allocate her financial capital? There we go. I think I'm falling asleep. I think that's why. Question 4. How much of a $100,000 financial capital should a hairdresser allocate towards bonds versus stocks? State and explain your assumptions. Question number 5. Please refer to question number 4. How will your answer change if you found out that he owned a condo? Question number 6. How does the person's age affect which asset class they invest in? Please explain. Question number 7. You are considering investing in a mutual fund. The fund is a loaded fund and it offers you a choice. You can choose to pay a front-end load of 5% or a back-end load of 3%. If you choose the front-end load, the fund's MERs will be 2% per year. If you choose the back-end load, the fund's MER will be 2.25% per year. Assume that the fund expects to generate a return of 10% per year before expenses, and that you intend to invest in this fund for 5 years. Which choice will you choose? Based on question 8. Based on question 7, will your decision change if you intend to invest in the fund for 10 years? If so, find out the break-even holding period where you will feel indifferent between the two choices. Question number 9. You are now 25 years old. You want to invest $15,000 per year at the end of each year. In a mutual fund, the fund invests in a portfolio of securities whose expected return is 9% per year. The fund charges a MER of 1%. How much money will you have 30 years from now? And finally, last but not least, question number 10. Refer to question 9. What if the MER was 2%? Damn. The next chapter is the mathematics of portfolio diversification. And I'm going to assume that there's a bunch of math here, a lot of symbols that I don't know what they mean. So to read that would be pretty incredible, but I'm going to end it there. I hope all of you are asleep, and so no one's listening to me. But maybe some of you are watching this while trying to work and focus on something, so maybe just a little background noise. So you are hearing me. If that's the case, I hope whatever you're working on is going well and that you're having a wonderful day. But I hope everyone is as bored as I am. I'm about to go to sleep myself. And I hope you all had a wonderful, wonderful, wonderful time. If you want me to read actual books or stories or short stories or spooky stories or whatever it is, or you want me to read a recipe or a guide or a how-to or whatever it is, something interesting next time, I definitely can. I just thought I have this book with me. Every time I try to read it at night, I fall asleep, so I'm like, you know what, might as well read it to you guys and see if it helps you fall asleep as well. So yeah, thank you all for watching. I will see you shortly, and make sure to have a good sleep.